Is it possible for a person to time the share market? All the data seems to point to a very firm no. It's simply too hard to do. Many investors try to pick the bottom of the share market to take advantage of the following rebounds. This approach is referred to as market timing and involves making investment decisions based on short-term market movements. In contrast, a buy and hold approach involves buying shares and holding them over the long term. Irrespective of the market, an overwhelming body of research finds that this passive buy and hold long-term approach to owning shares produces long-term results. We crunched the numbers using the ASX 200 benchmark index, and our analysis showed just how big a difference it can make when investors miss out on a handful of the biggest rallies. Here's the performance of the ASX 200 index. Here's the performance of an investment in that index if you missed the top 5 days of returns. And here's the performance of an investment in that index if you missed the top 20 days of returns. If you would have tried market timing, there's a good chance you'd miss out on some of the biggest rallies. Humans have a tendency to avoid loss, called loss aversion bias, which can cause investors to throw their strategy out the window and sell when markets turn bad. However, this can be precisely the worst time to sell, as the biggest rallies can happen in the middle of a market fall. And the more of those big rallies that you miss out on, the lower your gains over the long term. Here's a chart of some of the biggest one-day rallies that occurred, and when they occurred in relation to recessions. A recent paper from JP Morgan revealed that timing the market is almost impossible to achieve, given that good and bad trading days fall so closely together. As at the end of 2021, 7 of the best days in the US had occurred within 2 weeks of their corresponding worst day, but often the gap between the best and worst days was much shorter. For example, March 12, 2020 was the second worst day of the year in US share markets, yet that was followed immediately by the second best day of the year. Over the last 20 years, 6 of the 7 best days occurred after the worst days. The close proximity of the best and worst days makes it virtually impossible to buy shares at the bottom before they climb again, as most people are not that quick or lucky. In other words, it is very unlikely that an investor could be lucky enough to consistently miss the worst days while being invested in the market for the best days. JP Morgan's final thought is this: it is important to remind investors that success is achieved through time in the market, not timing the market. And to quote Dolly Parton, if you want the rainbow, you gotta put up with the rain. We'd have to agree with that. Based on these findings, investors should consider having a well-diversified portfolio and holding it over the long term. ETFs are well suited to this investment approach by providing a convenient, cost-effective way to get exposure to all the major asset classes. ETFs track benchmark indices for various markets, including Australian and global equities, fixed income, cash, and commodities. You can use ETFs to build the core of your portfolio, investments that will provide your portfolio with a foundation for the long term, through the market's up and down cycles. So you can sit back and enjoy your investment growing over time, without trying to time the market. Check out some of our options for core portfolio investments on our website here. All of our ETFs can be bought or sold through an investment broker, in the same way you would buy or sell shares. Thanks for watching. Please like and subscribe, and we'll see you in the next video.